Well, yeah, tariffs. That wasn't in anybody's lexicon for decades, right? And all of a sudden it is.
Mm.
And that's something that the market isn't accustomed to dealing with. So the level of uncertainty is risk. So investors need to get compensated for that additional risk or uncertainty that they view as they're facing. Loan spreads or bond spreads had spiked, prompting an increase in loan rates. And then we saw a substantial reduction in loan volume, as evidenced by almost no issuance in CMBS for a week or 10 days. That's softened somewhat. Bond spreads have tightened a little bit since then. The market has absorbed more information and gotten more comfortable, less frightened about what might be the possible outcome.
Hi, Adam Gower here, founder of gowercrowd.com and host of Real Estate Market Watch, current events through a real estate lens, where I am trying to unwrap the uncertainty that everybody appears to be seeing in the market to help you make better investment decisions. And my guest today is Orest Mandzy, who is managing editor of Commercial Real Estate Direct, which is a subsidiary of TREP. And TREP tracks CMBS data and what's going on in the CMBS industry, as well as other aspects of the industry that Orest will be talking about. So Orest's perspective, again, is from the institutional investor perspective, those entities or institutions that invest in the loans or packages of those loans that sponsors take out when they buy real estate. Now, clearly, as you're going to learn, Orest has a very positive view of where the market is, diametrically opposed to mine. I'm actually glad to say. So you're going to get a very different perspective from him in our conversation today. If you have not yet subscribed to my newsletter, do please do so. It is at gowercrowd.com. Just hit the subscribe button over there, and you can always unsubscribe. And in that newsletter, I summarize in some detail the conversations that I'm having with my guests, including with Orest, of course, as well as providing a link to the podcast and to the YouTube page where we also produce or publish these podcasts. All there at gowercrowd.com. Also, if you're not connected with me on LinkedIn, please do so. I'm there. Just look me up, Adam Gower or Gower Crowd. I've been writing a lot on LinkedIn and having some very interesting conversations with folk on that platform. Okay, let's move on to my good friend, Orest Mandzy, managing editor, CRE Direct. Here he is right now. Orest, such a pleasure to see you again. It's always a delight. Thank you so much for joining me. Let's kick off with your article actually published on TREP this morning. We are May 7th, and it's actually unusual to date these things, but everything could change by May 8th. So I will date stamp it. The title was CMBS issuance jumps 110% in Q1 25, driven by single borrower deals. Okay, so what are the highlights of this piece, and what does it tell us about institutional confidence in CRE right now, and what should sponsors be reading into this?
The data tell us that there's plenty of liquidity in the market. So last year we had, I don't want to say a record year, but we had a solid year in terms of total issuance, 104 and change billion of issuance. That was the most since 2021. And as you and everybody else knows, 2021 was pretty hot. This year so far in 2025, the first quarter, we saw almost $37 billion of issuance. So liquidity is still there among securitized shops. Now, there are a lot of, we could call them outliers, these large buildings that get financed and they get, those loans get securitized through single borrower deals. Folks call them SASB deals, single asset, single borrower deals. What we like to focus on are the conduit deals. Those are CMBS transactions that are backed by middle market mortgages, say loans from, say, $10 to $25 million a piece. That's more granular, and that tells you if you've got good, solid conduit issuance, that tells you that there's plenty of liquidity in the overall market.
All right. A conduit is what? Let's just make sure we don't leave any of these terms of art.
Sure. So it's a CMBS transaction, generally about $1 billion in total unpaid balance and principal balance, backed by dozens of loans from multiple lenders. So, Starwood, Wells Fargo, they'll put together a package of loans and securitize them. In other words, repackage them as bonds and sell them to investors. The investors would be insurance companies, pension funds, money managers, etc. Because they're structured, the top layers have the highest possible ratings, and you go down the stack. So you could, if you're very comfortable with risk of against a certain property type, you could, maybe not property type, but you like the loans in the portfolio, you could buy sort of lower rated bonds because you're comfortable with the risk.
Right. And the loans in those, these are the loans that the sponsor on the street is taking out, right, to buy building out.
That's correct. Yeah. That's right. And they're, as I said before, they're middle market. So they're not $1 billion loans. These are packages of, I couldn't tell you what the average balance is, but they're roughly maybe $25 to $30 million a piece.
Okay. Orest, I totally forgot to ask. I think I did this last time as well. We should actually start with who you are and what you do. Why don't we actually start with that? Actually,
sure.
Interject that, then I'll go on to my next question. Yeah.
Sure. So I run the commercial real estate direct operation of TREP, and TREP is the biggest, we maintain the biggest database of mortgage data in the US. It's primarily CMBS data, and the CMBS market was started in 1995. So we've got billions of records on mortgages, and we also compile data on bank loans as well, or in other words, loans held by banks.
Okay, so back to our discussion about these record CMBS issuances. So Eric Sherman, writing in Globe Street just 2 days ago, reported CMBS delinquency rates surpassing 7% for the first time since 2021. Signaling specifically multifamily also saw substantial increases. So we've got this massive issuance, but on the other hand, we've also got massive delinquencies. What's going on?
Yeah, so data are data, right? But it doesn't tell you much until you dig into it.
Okay.
And so we did a little bit of digging into that. And while the headline number is frightening, and I'll totally admit that it is, if you dig in, you say, well, it's not really that bad. So the biggest multifamily loan that's now delinquent is the $1.5 billion mortgage. $1.5 billion, that's huge, against the Park Merced apartment property in San Francisco. Now that's
a single property.
One property. It's massive. It's 3,900 units, something like that. It was financed in 2020. I might be wrong, but it was sometime before COVID. It was financed, maybe 2019. COVID killed it. Right? If you lived in San Francisco and were able, and during COVID, they locked down San Francisco like Alcatraz, then you moved outside of San Francisco because rents in San Francisco were astronomical. So you'd move out of the city, work remotely, and that's the property in San Francisco, as everybody knows, hasn't come back yet. So they're still struggling. The owner of Park Merced is struggling to increase rents and increase occupancy at the property. So the property is now in receivership. So it was clearly over-levered now in hindsight. So if you take that and 3 other large loans, there's a portfolio of loans against New York apartment properties. And this it was written in 2021 with a floating coupon. So it was an adjustable rate mortgage. They have to refinance. Mortgage rates today are far higher than they were in 2021. So that loan can't get refinanced. and we have the same problem with a couple of others. So if you take the top four loans, multifamily loans that are now delinquent, that's almost 60% of all multifamily delinquencies. So
Interesting.
is there really a problem? No, it's something to be concerned about because it's still an elevated delinquency rate, I believe, for multifamily, but it's not as dire as the headlines would appear would make it to be. It's without a doubt, delinquency is higher than it was since 2021, but it's not as bad as it would appear because you have these outliers.
Okay, okay, so let's kind of come up to 50,000 feet.
Mhm.
When we look at CMBS as an indicator, or look at the trends in CMBS, do they serve as a proxy overall for multifamily lending health, do you think?
So we also look at Fannie Mae and Freddie Mac delinquency rates.
Mm,
They're totally different. Fannie and Freddie are generally, I mean, they are middle market lenders. I mean, the average balance on Fannie's books is something like $18 million.
okay.
Their delinquency rate is less than 1%. It's 0.63% if I recall correctly. Is it a proxy? No, because of that. So if you take out the outliers in the CMBS market, you're going to get closer to what Fannie and Freddie are seeing, but not quite. CMBS, and I'm not disparaging the industry or anything, but it always had been viewed as the lender of last resort. I don't know if that's a fair assessment of the industry, but it was kind of well known that if you wanted more proceeds on a loan, you'd go to a securitized lender. In other words, a CMBS lender.
Mm.
Fannie and Freddie tend to have sort of stricter underwriting guidelines, or had at least.
And if you wanted to go even higher up the food chain or lower down it, whichever way you're thinking about it, would you do you look at that? You might go to a CLO, right? For looser terms and or looser underwriting, higher LTVs, higher risk. Do you look at CLOs as well, Orest?
We do. So CLOs are a different animal, really. So
Mm,
in CMBS, and without getting too technical, in CMBS, when a lender writes a loan and securitizes it through a CMBS deal, they're selling the loan technically, right? So they get sale treatment. They don't own the loan anymore. The CMBS trust does. In a
mm,
CLO is a financing vehicle. So say XYZ lender writes a loan, they want to finance it, they could go to their bank and borrow money to finance their loan, basically,
mm,
leverage their loan. Or they could go to the CLO market, which became quite efficient at doing that in
mm.
2021 and 2022. So all the loans in another differentiation between the two is CMBS is typically fixed rate mortgages, right? The mortgage collateral is fixed rate. On the CLO side, they're floating rate loans. They're short-term loans. Say XYZ lender lends a loan for 2 or 3 years and they borrow money for 2 or 3 years. There's match funding. The CLO provides them with financing that has a 2-year term equal to the term of the loan that they're writing. So they like that. It fits their sort of their business plan
Mm.
nicely. Now, the CLO market, it's not as transparent as CMBS because the lender, I mean, the issuer is not selling the loans. They're basically using it as a financing vehicle. So when a loan goes bad, they'll often buy back the loan. So you don't see the delinquency data as cleanly as you otherwise would.
And what about in terms of relative scale? Again, thinking about at the sponsor level, right? So that entire market, the relative size, if this is a fair question, relative size of the CLO market versus CMBS versus agency, which is Fannie and Freddie.
Right. Okay. So the agencies are limited by the FHFA regulation. They can't lend more than $73 billion each. Last year, they did less than that, maybe roughly $60 billion apiece. The CLO market was, and I can tell you exactly because we had that. It was it was far smaller than if we saw $40 billion of issuance in CMBS, it was $8 billion in CLOs.
Okay.
So
Uh,
it's a fraction.
okay. And then are there any other buckets that we're missing when we think about the overall market?
On the securitized side, no, there isn't. But there are, CMBS is only one lender group, and call it CMBS CLO, the securitized business is one lender group. You have banks, insurance companies, and well, banks are the biggest. They lend typically 40% of all the volume in any given year. And
Okay.
from we spoke about this briefly before, banks are coming back. They're back in the market.
Mhm.
The debt funds, many of whom relied on the CLO market for their financing, they're active lenders still, but they're now facing a new competitor that they hadn't really faced over the past year and a half or two. The
Mhm.
banks, they're back to lending once again, which is good news if you're a borrower.
What are the standards? It's maybe not quite the right word for underwriting. What are the differences between the standards for underwriting between banks and CLOs then?
So CLOs are very driven by the market, right? If you can't borrow because the loans you're writing have let's call it a 75% LTV ratio, and the market wants a 70% LTV ratio, that's going to be a rough time. So you're going to have to become a stricter lender. From what we're hearing, underwriting standards are still relatively conservative. I think we can prove that out by looking at Fannie and Freddie's books, right? Because they disclose that their average LTV, if I recall, is 63, 64, 65% around there. And they're looking at their weighted average debt service coverage ratio for Fannie Mae, if I'm not mistaken, is about 2 times. So a property that they'll lend against has to generate 2 times the cash flow
2x.
necessary
Yes,
to pay the
really?
service. Mhm.
Oh my goodness. And CLOs are substantially less stringent, aren't they?
Well, so the issue that they face is that they're writing floating rate loans.
Hmm.
So as a borrower, you might face an interest rate cap requirement, and those interest rate caps could be expensive.
Um, Now we started talking about, I asked you about de-dollarization, but let me frame the question differently because your
Sure.
answer was, I'll just paraphrase, I haven't heard anybody complain about that yet.
Yep,
I
yep,
added the yet. You just said, nah, it's not an issue. But you have seen, and you've been speaking about market volatility.
yep.
So, how are debt costs and lender appetite being influenced by the current macro uncertainties like tariffs and policy, rate policy shifts, etc.?
So the market is always reacts to information that they gather, that it gathers. We saw bond spreads in the CMBS market, and as bond spreads in the CMBS market increase, lending rates necessarily increase as well, right? Because if you're promising your bond investors a certain rate, you have to make that rate up through the collateral. Um, that's, I don't want to say spiked, but it went up in early April before what some folks call Liberation Day, April 3rd, when the tariffs were supposed to go into effect. Interest rates, not interest rates, loan spreads or bond spreads had spiked, prompting an increase in loan rates. And then we saw a substantial reduction in loan volume, as evidenced by almost no issuance in CMBS for a week or 10 days. That's softened somewhat. Bond spreads have tightened a little bit since then. I guess as the market has absorbed more information and gotten more comfortable. I don't know if that's the right way to describe it, but less frightened about what might be the possible outcome, bond spreads and loan rates have come down a little as well. So we've seen an increase in, maybe not an increase, but a resurgence in issuance. Not quite to the levels of February and March, but it's improved somewhat.
When we talk about bond spreads, so what we're talking about is, I just want to try and visualize the structure of what we're talking about. So a sponsor goes out and gets a loan. That loan is then sold, securitized, and sold on somewhere in the form. And because you and I talked about dumb questions, so I'm going to ask a dumb question. Are securitized in the form of a bond of some
Yep.
sort. And then investors being institutional investors, then buy these bonds. So
Right.
when spreads increase, just define that concept for me. What does it mean, the spread increasing? And what does it suggest when the spread increases?
So bond investors price a bond based on the yield that they're going to expect. So as bond spreads increase, meaning the yield that they're going to get from the bond, as though that increases, the price for the bonds declines. So for instance, I'm looking at spreads for conduits this year. So at the start of the year, bonds, the AAA, so they're layered, as we said. The most senior class, the benchmark class, because it's the biggest class. It amounts to roughly 70% of a bond's overall size. At the beginning of the year, the bond spread was 80 basis points over what amounts to treasuries. Okay. So if the treasury was yielding 4%, investors were pricing those bonds at a yield 4.8%.
Okay.
That ballooned to over 100 basis. The last deal priced at 108 basis points over treasuries. So it's the delta isn't that big, but it's substantial enough to make an impact.
And so what that means is that so investors are saying, okay, we want a higher spread,
Right.
presumably because they see greater risk.
That's correct.
And then the underwriter at the sponsor level has to charge more for their loan because otherwise they won't be able to pass it upstream.
Exactly. Yes, that's exactly it.
Okay, so what are the influences at the moment, particularly? And they're always the same, basically, right? What's going on in the economy, the macro perspective, policy, etc. But are you seeing anything unusual at the moment in the markets that you've not seen before?
Well, yeah, tariffs. That wasn't in anybody's lexicon for decades, right? And all of a sudden it is. And that's something that the market isn't accustomed to dealing with. So the level of uncertainty is risk, right? And so investors need to get compensated for that additional risk or uncertainty that they view as they're facing.
So, you know what's curious to me about this, though, is that there is still uncertainty.
Yeah.
There was uncertainty on and after Liberation Day for about a week, and you said there was no activity. Goodness me, what's this going to do? It just froze the market.
Right.
Then there was this reversal in policy, at least for 90 days. So investors saw less risk, but that means that they are investing into a market that is still uncertain, and yet they're seeing less risk. So it's kind of counterintuitive to me. Do they suddenly see the future, or what really drives these decisions?
I think that they get a little more comfortable with what they're facing. I mean, there's almost a perfect parallel to what happened after 2020.
Okay.
Right? Even though it's kind of it's different, but everything is it rhymes if it doesn't mimic completely. So in 2020, nobody knew what was going to happen after or during the lockdown. So we saw almost no issuance, no CMBS issuance, but that came back. Even So I'm looking at our data in 2020. So in 2019 we had $97 billion of issuance. 2020 that plunged to 56 billion, and then by 2021 everybody said, well, it's going to recover. So issuance skyrocketed to like $110 billion. So almost double what it was in 2020. And a lot of the 2020 deals were 2019 loans that finally ended up coming to market. But there was a stretch of time where there was almost no issuance at all, because how do you price a bond in a market of total uncertainty? When is the economy going to open back?
Right.
Things like that.
So do you see a shift in underwriting standards to compensate for this? Okay, so there's still uncertainty, but we're a little bit more comfortable. However, how are they covering the possibility of this uncertainty, or a kind of inflation, not inflation, but this inflation of doubt, or the impact of tariffs? Are they underwriting more strictly?
So right now it doesn't appear that that's the case, but underwriting has been relatively conservative since 2020. Average LTV is less than 60%. It had been, I'm going to say, in the low 50s, about 55, 54%, but that's been inching up as the market has gotten accustomed, I guess, acclimated to the new issuance. But there's some loans that were issued in 2021, 22 that are delinquent. So, it's you got to do your own underwriting, right? You have to always dive in with your eyes wide open.
Is there anything in particular that sponsors should be looking for? Again, I think of this, my audience, I think primarily sponsors out there trying to get loans. What should they be looking for? And, the undercurrent here, what I'm really getting at is the overall health of the economy and where we're headed. There's a lot of, that's the uncertainty. What is the impact going to be ultimately? So what do you look for? What should sponsors be watching for? You
really have to be aware of everything. It's underwriting is key. Turn over every possible rock.
Well, what are the key drivers today? Is it the uncertainty, do you think, Orest, or is it something else going on?
Yeah, I think there is, but I think, we also follow a lot of the REITs and we look at them closely. They're becoming not a little more, quite a lot more confident and positive in their outlooks. Camden is now looking to aggressively buy apartment properties. BXP, the former Boston Properties, is looking to make investments as well. So I think they view the market as already having hit bottom, and they're turning around, and it's turning around.
Interesting. So, do you agree?
As we know,
classic.
Markets are cyclical, and I'm always optimistic, and a lot of the data that we're seeing indicates that the worst is behind us, barring any black swan. If these tariffs all of a sudden throw the economy into a tailspin, then that's all bets are off the table.
So I did, touch on this question before we started, this idea of de-dollarization. But more broadly, the impact so the focus domestically is strictly on tariffs. But when you look outside the country and you look at how the rest of the world is viewing the United States, they see a breakdown in governance, in the institutions, or undermining, institutions, regulation, deregulation, the pressure on the Fed, etc. And they're beginning to lose confidence in the exorbitant privilege that the US has had in terms of lending at low interest rates through treasuries. Is that not something that anybody really pays attention to? It seems to me like it's like you talk about a black swan. That just seems to me like a flock of black swans hovering, ready to dive. basically.
Yeah, those are issues that if they're on everybody's mind, they're at the back of their minds. They're not front and center.
Mm.
I'm sure that sort of concern is you have to price that into your investments all the time, right? I mean, the world could end tomorrow, and then what's your apartment property worth then? So but it's not top of mind, or at least
Mm.
nobody complained to us about that.
Uh, Orest, did you have some slides you wanted to share? I know that sometimes
Yeah,
you have.
yes. Thanks.
So let's have a look at those uh,
Yep.
before I move towards our final three questions. But I suddenly noticed, gosh, it's amazing how fast our conversations go.
Yeah. It's well, when you're having fun, that's what happens.
I know exactly. Right. So have a so for those who are listening on the podcast, the audio podcast, let's just be sure to go ahead and articulate what these are. If you're watching on YouTube, you're going to see the screen. You can always find it on YouTube. Okay,
Yeah.
so what are we looking at here? Please describe
So
what we're looking at.
right here so we've been tracking the CMBS market for now I could technically say decades because it's been since 2000. But I only have the data here from 2010. So if you look, issuance has steadily climbed through from 2010 to 2015, and it kind of petered down a little bit, and then it started increasing again, declining substantially in 2023, as we spoke about. And last year we had a very good year, $104 billion, and so far this year, $36 billion. So we were on track to hit, $120 billion, or $1.6 billion, $160 billion if we were going in at that pace. That's probably not going to happen because April was relatively weak, and we're probably going to see another couple of months that are. So we'll probably still be about $100 billion of total issuance. Now, again, you could always look at CMBS as a barometer of the lending market's health.
Mm,
And if anybody wants this slide, I'll gladly send it to them.
thank you.
But I did here's some delinquency data, again, only on CMBS, which is what we track closely. The
Mhm.
office sector is still the one that market's in trouble. And again, all these data are influenced by some huge outliers. The same thing is with office properties. The $20 million loans on office buildings are also in trouble, but those that are 100, 200, or $300 million tend to sway the numbers far more than those smaller ones. And I pulled out the largest multifamily loans and describing what the issue is. So the NYAH portfolio, that's that portfolio of apartment properties in 4 of the 5 boroughs in New York.
Mhm.
That loan it's a floating rate loan that could be extended, but for it to be extended, it needs a rate cap, and they're facing a much higher coupon than they otherwise would have, than they did in 2021 when the loan was originated. The 180 Water Street, which is an office building that was converted into apartments in 2017, I'm going to say. That is evidently the owner of that is working on a term extension of the loan. So that's probably going to be it's going to be removed from the delinquency rolls in short order. The Park Merced is in here. That's massive. And another California property, the Cove at Tiburon. That we're seeing more and more of expenses increasing at collateral properties, especially on the apartment side, which makes them difficult to refinance when the time comes. Their rents had climbed. We wrote about an apartment property in Tampa, Florida yesterday, where rents had increased, or gross revenues had increased by 50% over the past 5 years or so.
Goodness.
But expenses had increased by substantially more. So, rent growth is nice, but if your expenses are growing at the same rate, you're not winning. So that's something to keep an eye on, especially in hurricane-prone areas like Tampa,
Right. Where you have
South
these
Florida and stuff.
current spikes, right? insurance particularly.
Yeah. Although we've heard that insurance costs have stabilized.
Are there any direct impacts of the tariffs on this multifamily market other than, I mean, the only thing I can think of is cost of any upgrades, for example, any
Yeah,
renovation.
yeah. Well, that's what we hear. And I don't know about you, but I I buy two by fours because I do a lot of woodworking projects and things like that.
Mm.
The cost of two by fours has plunged.
That's it, really.
Yeah, yes. So,
Something actually totally unrelated. You're same era as I am, I think.
mhm.
And I've renovated some old buildings from the 1920s where you see these true two by fours where they're really
Yeah.
tall.
It's
And you look at
non-dimensional
you look
lumber.
at the rings on
Yep,
those old ones, and you can't count them. The new
yep,
ones you can count them. There's like five. Right?
yep. That's right. That's
They're
right.
super young wood that tends to warp and do all kinds of ghastly things as well. It's always interesting to me. I've just been doing some work, and the general contractor was complaining about the quality of the wood and running around to find, the
Yeah.
best quality you could possibly find. I thought, I don't know, splitting hairs a bit. I mean, how different can it be? All right. So anything else you want to comment on here, as regarding multifamily? Oh, and so actually, yeah, let me ask you this. So rents have been going up, but the big question with tariffs is the impact on the employment rate, and this is clearly something that is important to the Fed. By the way, have you got any more slides?
No, that's
Okay.
it. I mean, I could.
Okay. Do you want to stop sharing then so I
Yes,
can
sir. We'll do that.
just see you directly? And the impact of that on uh, employment levels. And that surely will have the potential for that. People are talking about a recession. Maybe we're in one already. And if the impact on employment is significant, uh, surely that will have an impact on the entire commercial real estate market, particularly the multifamily market.
Yeah, for sure. Yeah, with the sort of the flip side to that is
Mm,
we've been underhoused for decades, right? We haven't developed enough housing units for a long time.
mm,
So it'll take a while for us to catch up to that, to catch up to the natural demand. Um,
mm,
so that's sort of the counter to that headwind, that potential headwind.
mm,
But there are other potential, like the industrial sector has been the powerhouse of the entire commercial real estate sector
mm.
for years. Tariffs could potentially have a substantial impact on that sector.
Uh, and how are people underwriting that risk?
That's a good question. Because how do you underwrite something that you don't know?
Mm.
We don't know what the ultimate impact will be. I mean, maybe the end result will be no change, but or maybe it's a devastating change where folks decide to vacate 50% of all warehouse space. Who knows how do you underwrite that? The uncertainty is too great.
Yeah, it's interesting. It's you and I clearly have different perspective on where the economy is going and etc. But to me, when you have this degree of when I think of uncertainty, I think of black swan events, and I really think
Yep.
we're living in one. Actually,
Uh,
it's
uh,
a
uh,
live, actively happening black swan event that you don't really know about until you look back. I
yeah.
call them black signet events. There's lots
Yeah.
of little baby black swans flapping about at the moment. And so
Yes.
it surprises me that until there is more clarity, that there seems to be so much confidence in the market, as you describe it, that there's this blooming issuance. Like, okay, we don't know where we're going. We're not sure what's going to happen, but what the heck,
Yeah.
right? Well, let's just
Well,
go
it's
ahead
not.
and lend.
It's not quite that kind of who cares attitude.
Mm,
You and I've been around a couple of cycles, right? So
mm.
you remember well, I'm going to go back a ways, the SNL
Yes,
disaster, the GFC,
right.
and then COVID, right? So coming into the GFC, right, things were very, very rosy. But
Hmm.
then things started tapering off substantially before the market kind of like bottomed out.
Hmm.
And it took a while for that to kind of even recover. I mean, it took 2 or 3 years. So are we seeing the same thing now? Um, it's too early to tell, I think,
Mm.
because we really don't know. I mean, the tariffs yesterday, we're going to tariff everybody by 10 to 14% or whatever the case might be. And then today is, well, we got deals with 14 or 17 or however many countries, and maybe it won't be an issue. So it's that kind of hopefully, I think Scott Bessent understands that. And that's why he's coming out and saying, okay, we're very close to deals with these 17 or 18 countries.
Mm.
Um, but we'll see.
We will see.
Mhm.
All right, so arrest. Let's have a look. Yes. Oh my goodness, it has flown by. I have three. I would love to talk to you a lot more, as you well know.
Adam, it's always a pleasure speaking with you.
Thank you. All right, so let me just move to my final sign-off questions that I've been asking all guests. So, what are the two, three market signals that you personally watch that give you early warning of any shifts in the industry?
So there's something that when we didn't speak about this today, but the special servicing rate.
Hmm.
So these are in CMBS, loans go into special servicing. Now, special servicer, like in the old days, they called them asset managers. They take over and they're workout specialists.
Hmm.
As their volumes increase, there's true risk in the market. And loans could transfer to special servicing because a tenant decided to vacate at the collateral property, or there's a pending lease coming, a pending lease rollover, and there's uncertainty whether the tenant is going to renew or not. So we closely monitor that data because I think it's more telling than the delinquency rate. The delinquency rate could be it could go up and down on a month-to-month basis, but the special servicing rate is a lot more durable. If it
And is
goes up, it's going to stay up.
special servicing is pre-delinquency or is it?
Generally speaking, yes.
Yeah.
Mhm.
So how's that looking?
It's been elevating. It's been increasing. Oftentimes, you could explain why it went up. It was, underwriting was in 20 last year. A lot of the 2014 loans were coming due. As they're coming due, they're facing higher coupons, or maybe, especially in the retail side, the properties didn't perform as expected, so they can't get takeout financing at the level that they had hoped. And that's on the retail side, especially, that's been the biggest issue,
Hmm.
particularly with the mall sector.
Is the requirement for additional equity in order to be able to refinance out of a loan?
Yeah, yeah, yeah. And equity is very, very expensive because of higher interest rates.
Yeah, that's right. And also you're seeing this double whammy, right? You've got values coming down because cap
Yeah,
rates have gone up and interest
that's right.
rates are still elevated. So it
Yeah,
makes it
yeah,
particularly difficult,
yeah.
to
Yeah,
underwrite.
and you earlier, and I don't know if this is one of your questions, were there other issues to focus on? We've been closely looking at insurance costs and property tax costs.
Okay.
A lot of these municipalities, San Francisco for one, and we're looking into that. So commercial property tax revenue for municipalities is generally the number one revenue generator. Um, I
Hmm.
didn't describe that well, but I think you know what I mean. Property taxes are the
Made
number
it
one
very
revenue.
clear. Yes.
So what does San Francisco do if all the values of all their office buildings is declining by, I don't know, 20, 30, 40%?
Hmm.
They can't jack up the property tax rate on these buildings because the buildings are sucking wind.
Hmm.
So the city leaders have to figure something out.
And so how does that serve you as an indicator? Is that what does that tell you, those property tax?
Well, in a lot of those, I would think in cities like San Francisco, maybe New York and others, you go where the pockets are, where the deep pockets are. So they'll just say, well, your tax rate is going to go up. And then the property owner says, well, that means my property is going to go down in value further.
Ah,
So it's another sort
vicious
of,
cycle.
yeah.
All right. So if you were advising, I'm primarily talking to the borrower, the end user, if you like, somebody out there getting a loan. So if you were advising a borrower, a commercial real estate sponsor, or investor who's sitting on cash at the moment, what would you tell them to be doing over the next 3 to 12 months?
Oh, wow.
Invest now, buy
Oh,
now.
I hate to give investment advice because I'm the worst at it, but I
Mm.
always think, and people will probably dispute this, but look for positive leverage. Buy a property at a high enough yield that when you place a mortgage on it, you're getting positive leverage as opposed to negative leverage. Don't count on an increase in your cash flow to generate that eventual positive leverage. Get it from the start.
Yeah, I could strongly agree with that. You want to be coming in solid.
Yeah,
And
oh
also
yeah, yeah.
low leverage, presumably.
Yeah, that's right. If or no leverage, right? If you don't have a mortgage, you can't default on a
You're
mortgage
not going
then.
to lose the property. Yeah, we
That's
actually have a
right.
client in Chicago who does B and C industrial, and he went through the global financial crisis, lost a bunch, and buys everything cash.
Yeah.
He's just a yield player. I do not want to lose money again.
Yeah, that's great. And real estate has so many advantages that other asset classes don't. Um, Depreciation, things like that.
All right, so we did touch on some of this. My last question, we did touch on some of these, and you sound actually very confident in the market, which is diametrically opposed to me. We're going in completely different directions on that, so we'll have to revisit later.
Sure.
And
And again, I'm an eternal optimist. So
well, I am too. I like to think of the glass as being always full. It's got half water, and the rest is air.
yeah.
You know,
I became an optimist after surviving cancer. If I did
ah,
that, then I could do anything, right? Or the market could do anything too.
oh, gosh. Well, that's a nice perspective. And I was going to say something else, and I can't remember what it was because that's much more profound than
You
my
know.
than my the witticism I was thinking of lobbing out. Let me finish with this last question. All right, so Orest, what political we didn't really get into, pressure on the Fed and influence on interest rates and kind of some of this other stuff that's whirling through the news feeds at the moment. But what political or market developments are you tracking that you anticipate could give you pause to rethink your assumptions about the way the market is going?
Wow.
What would change your mind?
I think a spike in interest rates, right? So the Fed controls just the short-term rate, right? The Fed funds rate.
Hmm.
Um, if all of a sudden bond investors like China, Japan stop buying treasuries, then we
Hmm.
got a real problem. And then all bets are off the table.
Okay, but that was the answer to my question about de-dollarization. You said nobody's worried about that.
Yeah, no.
So nobody's worried. I mean, that's what you're watching for, but there really is no sense of.
Yeah, it's not going to happen tomorrow, but that's that has to be a concern.
All right, let me get your title right. Orest, you are what is your title actually?
Well, I'm the managing editor of Commercial Real Estate Direct.
Okay, so now I can wrap up properly. Orest Mandzy, managing editor
Managing editor, yes.
of CRE Direct, which is a
Yep.
subsidiary of TREP.
Trepping, yep.
Enormous pleasure seeing you. Thanks so much for
It's
coming.
awesome speaking with you, Adam. Thank you very much.
All right, that was Orest Mandzy, managing editor of CRE Direct. What an enormous pleasure. Oh my goodness, Orest. It's so nice to see you again. It always is. And really appreciate you taking the time. You always put together a little presentation and a little deck for us to have a look at. So I do value the time that you spend preparing for our conversations very much indeed. Thank you. And thank you too, dear viewers and listeners. We would be nowhere without you. I hope you found Orest's insights into what's going on of interest. Clearly, he has a confident and optimistic view of where we're headed, as he said and indicated. So maybe listen to him and not to me, because I have the opposite view, as you know. If you've not already subscribed to my podcast, to my newsletter, please go to gowercrowd.com, hit the subscribe button and sign up there. If you've got any questions, as soon as you get one of those newsletters, just hit reply. It comes directly to me. I'll be happy to answer any questions you have. And if you've not, or if we're not connected on LinkedIn yet, go to LinkedIn, look me up, Adam Gower or Gower Crowd, connect there. I write a lot on LinkedIn, and I do love to hear your comments, particularly on that platform. Okay, that's it for this episode. Until next time, it's Adam Gower signing off.